Hi Abhinav, am I audible?
Yes, Neil.
Hi Satya.
Hi,
Hi.
you're audible, yes.
Folks, we joined early for mic test. We will start at 8 o'clock as planned. I think a lot of people will have their eyes glued to the screen. Probably the Nasdaq down 3.3% as we speak.
Neil, I can't find Satya. If you see her, please add to the group.
Sure, will do. Hi Deepak. Hi Deepak, can you hear me?
Deepak, you're on mute.
Hi, can you hear me?
Okay.
Yes. Exciting day
Awesome,
to put
awesome.
it mildly.
Always exciting. Markets are just brutal.
Matlab, market is not taking a break also. Like it's not like spread out a little bit. It's every day gets more exciting than the last.
The curse is may you live in interesting times. No? This is it. Every it's just like blood pressure. I just when it goes up, it stays up, and then when it comes down, everybody complains that it's boring.
So there is this book by William Bernstein called The Investor's Manifesto. He is very, very quotable, and I'm going to quote some very interesting parts from that book. So he's a neurologist and an investor.
Oh, okay, okay. Please go ahead. It's always good to hear. I'm sure this is not a new phenomenon. So we've seen this in COVID, we've seen this in 2013, 2008, more probably
Yeah.
more likely, and but it's not that overwhelming sense of despair that we used to have in really deeply destructive markets.
Hi,
True.
sorry, Deepak, this is Abhinav call. Your audio is bit loud.
Wow, we've never had that problem before. People have.
Yeah,
Hi,
now
Nilesh.
can you hear me? Yeah, sorry. Right?
Hi, good evening, Neil.
Good evening, Nilesh. Yeah, Deepak, we can hear you. Do you want to test it out one more time?
Yeah, can you guys hear me now?
Yeah, brilliant.
Awesome,
Perfect. I think Abhinav, it's fine, no?
Yes, yes, much better.
awesome, awesome.
Cool. Folks, we'll begin at 8 o'clock as scheduled. If some people join late, then they can join as we go along. So, yeah, we will begin in about a minute's time.
Nikhil is here. Hi, Nikhil, I made you co-host, part of the group.
Hi, hi, Nikhil.
Hi guys, sorry I was on mute. Hi everyone. Can you hear me?
Yes, absolutely.
Hi, Nikhil. Hi, Nilesh. Bhai.
Hi, good evening.
Hi Nilesh, hi Deepak.
Okay, so it is 8 o'clock. We will begin promptly as scheduled. Shankar will join us, and when he does, we will add him to the panel. So before I begin and introduce the topic, let me, as I told Deepak, I'm going to quote some very interesting texts from the Investors Manifesto by William Bernstein, and this one is very apt for today. So he says that the rewards of equity ownership are paid for in the universal currencies of financial risk, which is stomach acid and sleepless nights. So some of us might be having some of those, but if you are, then you're in good company. So let me first introduce the topic. Um, why are we discussing this today? So basically, since 2008, and in fact, even before that, whenever there has been the threat of a recession, the central banks, and more specifically the US Fed, have always rescued the markets. It was historically called the Greenspan put when Alan Greenspan was the chairman of the Federal Reserve, and then his successors continued it. And they did not see much inflation materialize in all these years, which allowed them to continue it. That seems to have changed this year. That seems to have changed that entire um, environment this year, which is why we are kind of having a deeper conversation on how this market will pan out. So let me first invite Nikhil Kamath to um, lay out the bearish case. Now, let me first say that Nikhil is only 50% hedged in his two beacon portfolio. So he is by no means short the market, but he has long maintained that the market was due for a deep correction. And so, Nikhil, would you like to go first?
Yeah, thank you, Neil. I think we have like three or four big issues. Uh, I would say not particularly for India. A lot of these are global, but they do affect us in India. I think for a long time, this trade deficit has been a problem, but ever since this rally in crude and commodity price inflation, I think it's becoming a bigger and bigger issue of late. At $20 billion plus per month, I don't think it will take a long time for India to, in a way, run out of the reserves that we have. For a long time, we've been talking about, the 600 billion number and how fiscally we are strong as a country. I don't think that case will remain the same forever. Inflation again, like I was watching the federal policy speech last night, and even today, even with 8% inflation and them raising the federal funds rate to 1.6 or 1.7, there does not seem to be a logical path as to how they will contain inflation by virtue of doing that. Uh, the inflation rates for the first half of the year in America have been 7%. So for them to take it down to the target rate of 5%, they would need inflation to be around the 3% number in the second half of the year. And I do not see at 1.6 what interbank or inter-institution rate, or let's say their 10-year treasury rates are now 3.5%, or even if their mortgage rates go up from 5.5 to 6%, I still do not see how they will get inflation down to 3% for the remaining part of the year. I think this is an issue which is not just in the US but across the world. To a certain extent, central banks uh, lag what is happening on the ground, and I think we kind of like take too long to come to terms with reality. And One might even debate that without a central bank, in the sense that no central bank tweaking policy, adding money, withdrawing money from the economy, would there be lesser busts and rallies in the market? To a certain extent, that might be justified as well. So I would say trade deficit. I would say inflation. A general slowdown in the economy. I think we were slowing down pre-pandemic at a significant pace. What the pandemic did in many ways is create a lot of confusion, both on the way up and then on the way down. But we seem to have a structural problem in the country. I don't want to get into demographics and how, like 1% or 1.5% of the country pays maybe more than 10 lakh, declares more than 10 lakh rupees in income, and how low our GDP per capita is, or how bad the real numbers on the ground actually look. But there's plenty that is wrong with the economy. But I feel the first step towards fixing a problem is probably addressing the problem. We don't seem to be addressing the problems we have at hand, and we kind of like, shift focus to something smaller, which might be working, but ignore the larger things at the crux, which are really, really big problems for us. Yeah, so for these three or four reasons, I would say uh, markets seem expensive. I could even argue that even today, on a relative basis, India seems to have corrected lesser than other countries. And yeah, so those would probably be the starting points, Neil, towards making a bear case.
Nikhil, could you lay out the connection between the Fed raising rates and our markets in India going down?
So a lot of the reason for our markets to have gone up in the last couple of years, I would say the last maybe 1 year or 8, 9 months might have been ruled by domestic inflows coming in because FIs have been selling for maybe 7, 8 months now. But to a large extent, not just the public equity markets, but the private markets, free money printed in the West seems to have percolated its way down into emerging economies, more so India than other countries. The ecosystem I work in, right? Like I'm part of the startup ecosystem. I live in Bangalore and I get to interact with a lot of these people. Money was just flowing into the economy like there's no tomorrow, right? Like there would be companies which thought of creating a product, they would get funded like $10 million, and when it looks like they're starting to sell, they would be 100 million, and when they actually sell a little bit, whilst they're still losing a lot of money because of marketing and customer acquisition and stuff like that, they would become unicorns. And I don't think that is sustainable. Uh, at the very core of it, companies are about making a profit. I think businesses have to make a profit to sustain and thrive. And we all seem to have forgotten that at some point. We all, including myself in Bangalore, because of how our ecosystem, how everybody around, if everybody around you starts to get money from, a foreign player, and you don't really understand why he's getting access to money for as low a rate as he is, I think we all get deluded and kind of like dissuaded around reality in a way. But yeah, so I think that extremely cheap money in the West, how much did they print? Like $11 trillion in the last 18 months or 24 months. That's as much money as they'd printed in the history of the United States. A lot of that found its way into India as well. And I think that kind of whitewashed what was happening on the ground. It kind of like brainwashed us into believing that pace or that stream of money will continue to come in. Now, when the cost of capital goes up for these VCs and PEs and all the people bringing money into the country, I think things will change significantly and people will feel it on the ground because startups have hired so many people. If there is one lean cycle, if 2 years we are not able to raise funding, or companies in this ecosystem are not able to raise funding, they will have to fire tens of thousands of people, and this in turn will again reflect in the economy, and that pain will be very visible for us to see, even in the Twitter world that we all belong to, because this is that ecosystem which will get hit.
Right. But I have seen several data points which seem to suggest that the role of FIIs is diminishing in our markets. Nilesh, what is your take on this? Do the FIIs still command the same weight, or are retail investors making a difference?
So, Neil, investors are investors, whether they are foreign or they are local. Both need to make money on their capital employed. FPIs were owning 21.5% of NSE 200 at the peak holding. In March 22, they came down to 19.5%. And based on the selling of April, May, and June, probably they are somewhere around 19%. In recent times, they were at the lower of 18.6%. So, undoubtedly, they are an important part of our market. They have been selling for last 7, 8 months, but that's probably also because India has delivered double the return of its emerging market peers in last 8 years. We trade at the of emerging markets. As oil prices go higher, we will get impacted because our oil intensity is higher. And probably India is the only market where they are able to get an exit without much price impact because there is domestic investor buying in. So FPIs continue to play an important role in our market. And while it is encouraging that domestic retail investors are participating in market, we need to augment domestic and global capital together to pursue higher growth.
So, Nilesh, you therefore concur with Nikhil's bearish assessment that this correction has a lot further to run. India is no different. We can't decouple from the rest of the world.
So India is a country which does not disappoint an optimist or a pessimist. In my opinion, a lot will depend upon how events shape up. What if tomorrow there is a political solution to Ukraine? The war comes to an end and oil prices come down. In that scenario, certainly market outlook will be brighter. The second thing could be, what if US removes sanction on Iran, Venezuela? What if it persuades Saudi Arabia to break OPEC cartelization and energy prices come down? Undoubtedly, as Nikhil mentioned, we run higher trade deficit, but we import about $70 billion of gold every year. This is at the current run rate of $6 billion a month. Now, gold is not an item of consumption, it is an item of investment. We are paying 50, $60 billion extra for higher oil prices. So, if tomorrow things change, certainly market outlook will also change.
Right. So essentially, we need an external trigger like the war coming to an end or the OPEC cartel going away or being reduced in some way. Deepak, how do you see this? You very famously wrote a piece where you explained how retail investors seem to be driving the market. Is that not the case anymore?
Neil, I think it still is to a certain extent, at least from the NSE bulletin. We continue to see that from a daily trading perspective, retail are still significant volumes in futures and options, and the cash market as well, I think.
Hi, Deepak.
So,
Uh, there seems to be an issue with your connection. We're losing you in between.
oh, apologies. I think, yeah, this. I'm sorry, I'm actually having to drive to the airport, so there is a bit of a lag in the mid. Can you guys still hear me?
Yeah, now we
Yeah,
can.
this is better.
Okay. Yeah. So, what I was saying was, I think the retail investor continues to drive the trading volumes in the market, and that has come about. It's not something new. India has always had a 20% plus, volumes coming in from retail, and this time it's gone. It went all the way to 40, and now it's down to about 30%, possibly, and they continue to be drivers in the futures and options markets. It's just that retail investors don't seem to hold their positions too long because after all of this, they own like 9% of all the stocks in terms of market cap. Mutual funds own about 9 or 10%. FIs own about 19%. Promoters own roughly 50% of the overall market cap in India. So the people, so I think retail investors continue to drive volumes. They just don't seem to hold. Um, Having said that, I don't think there will be a position where retail investors alone are able to counter, for instance, large amount of selling by foreign institutional investors, which although has happened at a brisk pace, we haven't seen liquidation level selling from foreign investors yet, as in that they will sell at any price, and they have done this in the past. It has happened in 2008, it's happened in 2020, and we haven't seen that liquidation level selling, which you know, at which time we'll actually really see whether domestic players are able to offset in any meaningful way whatever is happening in terms of the selling by FPIs. It's a normal part of markets, though. We have only 16% from the top, so I don't think we should bottom yet.
Right. Um, so far we focused on flows and who is driving the market, FII or DII. But really, in the long term, fundamentals matter. And there, how does the scenario for India look? Shankar, how do you see this? Shankar, you're on mute.
Okay, my apologies. Yeah, right. So India is basically Andho mein Kana Raja situation. So while our fundamentals are not worth a lot, but relative to fundamentals elsewhere, we are looking absolutely smashingly good. And in markets, that's usually good enough to ensure at least one thing, which is outperformance. So I don't think absolute returns are anywhere on the horizon just yet. That will happen, that will change. Markets are not permanently good or bad. But fundamentally speaking, we have our own problems, we have our challenges. We have seen how, you know, sort of our debt to GDP, our trade deficits, our actually the twin deficits themselves are on a very, very worrisome path for sure. And it can only worsen from here given where the rupee is headed, which I think is sharply lower. So, all things considered, we have our problems. Not that India is in some other planet with no problems. We have problems, but relative to what one observes in the US, for example, or even in China, for example, which are, let's say, the two major economies in this world, uh, and of course, Latin America has another set of problems. So relative to the world, we are looking good on fundamentals. So, that's all I can say. And therefore, I do believe that while we will hurt, we are hurting, we will hurt a lot less than rest of the world. So I think if people had a choice of, if I had a choice of putting money into only one market, that would be India. As simple as that. It does not mean I'm going to make quick bucks, quick gains. It'll be a painful process out of this current pickle of a situation, but it is the least worst option for an investor who has options to invest globally.
That's actually quite heartening because if FIIs are getting out, they are making stocks at good fundamentals cheaper for the likes of us, which is some comfort. Nikhil,
So
would you agree with?
So
Yeah.
now, no, let me add to that. The FIIs are getting out of stocks where they can get out of. Okay. The interesting thing here is that those are precisely the stocks that you should not be owning because they are actually overvalued stocks. I mean, for example, banks are 35-40% on the index. Most FIIs own truckloads of them. They've been overweight and grossly wrong on most of them for the last several years. For that matter, mutual funds. And those are saleable, they are large and liquid names, but they are not great investments. So they are selling those. Doesn't mean you have to necessarily go and buy those. In fact, the under-owned part of the market by FIIs is really the small and the smallest cap part of the market. And that is the area where you'll actually be, let's say, less vulnerable to large sell-offs by FPIs and FIIs or whatever you want to call them, because they will sell what can be sold. You cannot, for the love of or for money, sell a small cap stock in a market like today's, for example. It's they become non-saleable, and FPIs don't anyway own a lot of them. So that's actually, in a perverse way, the safest part of the market from the brunt of FPI selling.
Despite the stellar rally in small caps over the past few years.
Yes, so I believe that is the single best part of the market that I can see where, notwithstanding the current sell-off, a year from now, many stocks will be a lot higher. I mean, even in this last 3 months of carnage, even in the last 3 months of carnage, several stocks are 50%, 100% up. in that space with decent fundamentals. These are not manipulated stocks or anything of that sort. So that's an area of the market which I believe is immune to FPI selling because they don't own anything, and there are enough pockets of growth for those companies available in India or internationally, which will keep their numbers looking fairly good, which is not going to be easy for the larger companies.
Right. Nikhil, would you agree with that assessment that smaller caps offer refuge in this sell-off?
To a certain extent, maybe, but uh, I think smaller cap companies also tend to have a lesser moat around them. They're not generally sitting on a lot of liquidity, and they generally are a bit more levered than larger cap companies. So maybe in the current scenario, yeah, but when things get worse, if things get worse, another 20% down if markets were to go there. Uh, I wouldn't be surprised if smaller cap companies are more strained than larger companies which have a bigger moat in place.
Right. Now, the other big rotation that's happening, and for the past more than couple of months, is from growth to value stocks. Nilesh, to what extent do you think staying in value will shield one from the overall sell-off?
So growth, value, growth at reasonable price. These are all the class and compartments created by investors. At the end of the day, you make money by balancing between your greed and fear, by focusing upon valuation. Now, there were companies which were cheap and hence called value. They got re rated based on certain events, like coal prices went up, coal companies went up, power prices went up, power company went up. So, my recommendation is that let's not fragment yourself in growth versus value versus GARP. Focus on buying good companies run by good managers available at good prices. Very easy to say, very difficult to execute.
Absolutely. So, Deepak, would you either say that value stocks or small caps have some kind of refuge value or not? Sorry, Deepak, I think because you're in a car, we're not able to hear you very well.
Hi. Sorry,
Yeah,
did you could you repeat the last part of that question? You said small caps after that.
or value stocks, as pointed out by different people on the panel. I mean, I,
Yes.
I raised the question of value stocks. So, do either of them offer some kind of refuge?
So I think in a system like this where liquidity is driving out money from markets, even stocks with good fundamentals will get destroyed if the liquidity parameter happens to hurt them. For instance, if a large fund sees margin calls or something like that, it will sell what it can sell. That when it can, and that small cap is also going to get destroyed. So, in a time when fundamentals don't quite matter as much in the short term, there's nowhere to hide. Everything will get hit. It'll just be, in the end, we'll decide what was a defensive and what was not. At some point, pharma was a defensive. Perhaps now it is not. At some point, FMCG was a defensive. At this time, I see that as much more potentially damaging because they have been raised to enormous valuations. Uh, it's going to be about the next, if you're thinking of the next 5 years, I don't think you should be essentially worried about what happens now in the next 6 months, and to buy stocks that are going to not give you I mean, not going to hurt you too much in the next 6 months. Everything will hurt. But the point is to find companies that can give you great returns over the next 5 years. You have to bet on the people that will survive this carnage, whether it is worldwide inflation or liquidity challenges. I know it may not be evident to us who will win. The idea is to discover who will win and then stick with those. Be expensive, some of them may be small caps, some of them are not qualified. They will all give you great returns if you find the survivors.
Okay, fair enough. Um, Now, Nikhil, yours 50% hedged into Beacon, but is there a approximate level? I'm not going to exact numbers here, but is there an approximate level where you think the market becomes attractive, the Nifty on the Nifty?
So, Neil, up until today, I think today for the first time in a long time, we saw like a 500 point correction from 920 to 330, and there was basically no attempt at a recovery whatsoever. So I don't think there was much panic in the market up until today. You know, we went up from 7.5, 8,000 to 18,500, and maybe we sit at 15,500 today, which in isolation might not seem like a significant correction, whatever, 18, 19, 20%, right? But things are starting to look like, people are panicking for the first time. And generally in market cycles, whatever I have seen, things get a lot worse before they start to get better. So I would say that true panic has not come into the market yet. The one thing we can all kind of agree on is inflation on the ground, pragmatically. It feels like it's a lot higher than the 7, 8% official number. And if it were to actually be higher, I think interest rates will have to go up for a significant amount of time before they're truly contained, even in India. So if interest rates go up to that, like 10% level, which today has become fathomable to a certain extent, there will be corporate margins which hurt a lot. You take anything from real estate to manufacturing. Take the most levered of industries to begin with. I think margins will see significant impact. So how much you downgrade earnings in the next year or in 2024, I think that's a very tough question for someone to answer because nobody truly knows where interest rates will be 2 years from now and how much corporate margins will get impacted. But the one thing I can say fairly is the pain does not seem like it's over. And I don't think the next 2 years will probably be like the crazy bull markets of the previous year or the previous 2 years that we've witnessed. I think there will be pain, and I don't think it'll be short-term pain, but it'll be long-lasting pain.
Okay. We seem to be heading towards quite a bearish consensus here. Can I invite anybody who'd like to offer some kind of positive that investors can focus on?
I can say one thing. If all of us are bearish, it's probably a good thing for the market, right? Generally, when we all have consensus, the opposite happens.
So, Neil, I don't think so. We are bearish or bullish. I think we are, and we need little bit of luck to change the narrative. If energy prices come down, this whole narrative on inflation will disappear and markets will rebound. The FPIs have sold, but remember in March 20 they were selling without any limit, and October November 20 they came to buy at higher prices. So we have to focus on our growth. Today we are in far better situation despite current challenges compared to other countries.
Sure. So India is better on a relative basis, as Shankar also said. And in the long run, fundamentals win out. But in the short run, there will be a lot more pain. That seems to be the broad consensus here. Deepak, you want to add to that?
I just want to add, I mean, I'm very bullish longer term. I just don't feel that right now is a great. I mean, this is a function of liquidity. When you take out money from a market in general, worldwide, and that's what's happening, the RBI has contracted its balance sheet by 500,000 crores. Well, not. The excess liquidity has come down by about 500,000 crores in general in the economy, and that's been driven by the RBI. The Fed has not yet even started, and they've only started talking about doing it from now on. In such a situation, you can be bullish about the economy, and the economy will do well, but the markets will not perform correspondingly because liquidity is what drives markets. So we can be bullish about the economy. It's a great country. It's a great this thing, but markets will behave badly when liquidity goes out of them, and until some stability is reached, it's like you have to brace for impact, take the pain, and move on. It doesn't make sense to, at least for me, it doesn't make sense to be. To say that because I'm bearish, I don't like the Indian economy, or because I think the markets may fall more, that I don't like the economy. I think economically we will do well. It's just that markets may not correspondingly perform.
Deepak,
Quite.
I have a question. Do you have any indicator that will tell you that the markets have bottomed out?
If I had one, I wouldn't tell anybody I did.
Nice. Shankar, do you have any indicator?
Yeah, yeah, there are many indicators, boss. Many indicators, not one. Many.
Can
But
you share
but if
some?
I tell but if I tell you, I will have to kill you. So yeah, but if you spend long enough in the markets, you can build very strong indicators. And that's something, frankly, when I got the markets wrong in 98 because I was very, very short and I lost a lot of money in 97. That's the time when I started working on that, and it has worked very well for a fairly long period of time. So yeah, you can build a lot of indicators that tell you don't have to get it down to the last day, although sometimes you can. And I remember my biggest trading mistake happened in 2009, March end or April beginning, if I remember correctly, when my indicators told me that this was absolutely the bottom of the bear market, but my heart overruled my methods and my system, and I regret that day. Therefore, after that, and I've never ever gone against what my tools tell me. So we are all human beings. We fall, we succumb to the madness of the moment. But ultimately, if you come out of this, you will come out of it only through a systematic strategy and not through your emotions telling you good or bad that this is the bottom, or this is a great time to buy, because that is a perennial war cry in the Indian market in particular, where our investors have no capacity or stomach to hear the bad news. We only want a one-way news, which is that good news or better news. So if the index Sensex was at 65,000 today, it can go to 75. When it has come to about 50 or 51, wherever it is, it can only go to 65. If it comes down to 35, God forbid, it'll go back to 40 or 50. But at 51, nobody's going to tell you it's going to go to 40. Or at 65, nobody's going to tell you that it's going to go to 40. Because if you say that, then all hell is going to break loose. So we are, unlike the US, if you see fund managers, large money manager, the whole company. It's a very nuanced, balanced set of people who look at good, bad, ugly, and are not afraid to opine the bad news. In India, you will never ever hear that. So, which is why market bottoms typically you have to build through systems, your judgment, rather than look at just voices telling you that this is the market bottom, or because that bottom you will keep hearing permanently. I mean, even now on Twitter, if you go around, everybody will be saying this is the bottom. Some indicator is saying it's the bottom. But yes, the short answer to your question is yes, you can tell near about when things are bottoming out.
That's actually an interesting point that we don't have a lot of bearish commentary in India, and in fact we have Cat 3 AIFs, which are technically hedge funds, but I haven't heard of one which is net short. Nikhil, if you could elaborate on that, and
Yeah,
also,
so
yeah,
yeah, so Neil, in Cat 3, I mean, you can be net short, but the problem is taxation. Uh, so on the short side of the portfolio, the derivative side of the portfolio, they tax you as a trust, and you end up paying 43% tax on the gains made on the short side. So if you net turn profitable by being short, you pay like 43% of that as tax. That's a big problem.
interesting. That's like an inbuilt long bias.
Yeah.
Um, Now, the other thing I was curious about is, are global markets better than us in some ways? I mean, a year ago, you were talking about how the tech titans would take over the world, the Zooms, the Metas. Now, all of that seems to have gone into reverse. So, have the fundamentals there changed, Nikhil?
So Neil, we are a very, very small market. Like I feel like we've done an incredible job of marketing and branding what we truly are. I was looking at some data earlier today, and the number of unique investors who trade in the equity market on a daily basis in India is something like, 15 lakh people. At the peak, it was 20, 25 lakh people. We're not a very large market. Like compared to, say, America by virtue of market cap or by virtue of the number of investors or traders, we're next to insignificant. In many ways, I think the scale, the level of technology, like, we have tech companies here in India, but there is very little innovation that truly happens in India. Even companies like ours and companies in our ecosystem, we are companies which are able to kind of regurgitate what has happened in the West and replicate better, and those companies scale in India. Uh, Structurally, that is a problem for India that so little innovation, so little money actually goes towards research in India. For that reason alone, I think American companies continue to remain extremely attractive, both by virtue of the fact that they spend most innovation dollars and they truly have scale. I really feel like this capital control problem in India is really bad. Uh, if somebody in India wants to invest into a tech company outside, the red tape and the regulation around that is so cumbersome that it's really hard for Indians to get exposure to, cutting edge tech in the West. You have to, like, take a bunch of approvals. You have to do it under a cap. Taxation is complicated and all of that. The need of the hour might be really to simplify that and allow Indian companies, allow Indian entrepreneurs to get exposure to, Western tech, allow us to invest in those companies more easily, because only then I think will that knowledge transfer happen on a real time basis. Outside of the fact that, we do have to, really throw in a lot more money on creating a more robust ecosystem onshore in India, which encourages innovation in a way.
So, to put it succinctly, yes, there are kind of better companies, at least in the tech space in the US, you would say, and some of them seem to be trading on even cheaper valuations. Shankar, how do
Yeah,
you
I
see
mean,
this? Yeah.
no, I agree. Go on, Shankar.
What's the question?
Are there more attractive opportunities in other markets such as the US?
No, are you talking specifically with regard to the tech companies in the US?
So the discussion has been around tech in the past 2 years, but I'm happy to broaden the question.
So the tech stocks in America are really cheap. They have been cheap for the last 2 years also. I mean, I've looked at those companies. You look at even FANG stocks or, just slightly south of the FANG stocks. I mean, mid-teen multiples for really globally sized and scaled companies. While in India, even for, very mediocre companies, 40, 50, 80, 100 times earnings has been par for the course. And not just in the last 2 years, but I mean, over decades, which is why I've always felt that it's just India. Many Indian companies do not deserve these multiples, and I've been wrong. They've traded these multiples now consistently. I think for 25 years, all your FMCG set has been north of 50 times earnings as a general pack. Even our banks have traded at 4 or 5 times book value. Again, insanely high relative to most other banks. So India is not a cheap market, and US has been a really cheap market on the tech side. I mean, really amazingly cheap. But that said, I've never believed that valuation itself is the be all and end all of making money in stock markets. I mean, overvalued things can keep getting more and more overvalued. We've seen that over cycles. Undervalued things can remain undervalued a long time. And in India, in fact, this is the, we have heard that in the 90s also, and we used to joke about it that the P ratio, is basic nothing but a representation of the number of years a company remains in business. So 5 times earnings basically means the company will remain in business for 5 years. So, and I don't think generally that has been wrong. In India, the lowest P stocks have gone out of business. High P stocks have remained in business. So, it's been exactly the opposite the way we have valued companies as opposed to the rest of the world. And I remember back in the 90s, stocks like Hindalco, etc., also used to trade at 25, 30, 40 times earnings. Tata Steel used to trade at crazy multiples, and I used to sit and wonder, looking at global steel companies trading at 4 or 5 times earnings, and people used to tell me that no, I mean Indian steel companies are better, or Indian aluminium companies are better. Thankfully, now they trade at more realistic and more global valuations because tariffs have come down and it's a more equalized sort of market. But India has been an outlier in valuation terms permanently. If you look at emerging market peers or even the US, US tech is has been cheap, but I don't think they are great buys because in a lot of ways the go-go years for them are probably behind them. Ultimately, if you think about it, a lot of those companies will hit a wall in terms of where they can grow because China is shut out for almost all of them. What is left is India, and again, I remember a year and a half, Netflix on their conference call said that we are looking to India for our growth from here on. And I tweeted that if moment an MNC, new MNC says that, then it is game over for that company because India is a tiny market. I mean, even if you take a OTT market, I don't know what 50 lakh people, maybe a crore people. And if Netflix's big white hope was India, it was a shot anyway. And that's exactly what has happened. So, for a lot of global tech companies from the US, they probably hit a wall in terms of their growth options. Amazon is out of China. So, where does it go for growth? India, you know the problem Amazon has. Facebook is an aging platform. Apple in a recessionary environment, I doubt if they'll be able to sell their overpriced, vastly undeservedly so phones anymore. So they've probably hit a temporary wall at least in terms of growth. Therefore, 15 times, 10 times earnings wherever they're trading at may well trend lower because they might report lower numbers than what the street is estimating.
So Shankar, if not US tech, then is there any sector or market that does currently represent good value?
I'm telling you, Indian small caps, guys. I mean, take a look at a company like Vadilal. Okay, I bought the stock at 1,000 rupees in March. Today it is 1,900 rupees. Who says Indian market has been a terrible market? I'm giving you one example. I can give you 25 more. The point is that in a bear market, we are in a bear market. Let us accept it. Okay. You will have to work harder to get to those 25, 50 names. Okay. In a bull market, all of us need to show up. That's it. You need to show up. You will make money. You'll go home. This is not that market. This is a tough market. In a tough market, you will need to be very nimble, agile, hardworking, figuring out companies, meeting companies. In a bull market, you don't need to meet anybody. It's a broad trend you're betting with. So, as I said, Indian small caps are a fantastic place to be in. And I remain absolutely firm in my view that a year from now, many of those companies would be up significantly, or at least will not be down as much as broad markets in India and globally might be.
Fair enough. One other solution, of course, that's often discussed to this kind of market is asset allocation. And AMCs across the country have products aimed squarely at that. Nilesh, how much can asset allocation really protect investors?
So the question, Neil, is, does trader want a protection? Does investor want a protection? Even in today's market, most equity funds returns are in double digit from second year onwards, and it is negative on a 1 year basis. Now, if you can take the downside, then certainly asset allocation will protect an investor. Asset allocation does not mean that you don't have to take downside. There is no free lunch in the market. You have to take upside as well as downside. And today, there are different kinds of asset allocation funds which are available. So, if you are an investor looking for a long term investment, asset allocation funds are like fill it, shut it, forget it kind of fund. It does not protect you from downside, but it ensures that in a cheaper market, you are adding asset classes. In an expensive market, you are booking profit. We have our balance advantage fund, which does allocation between debt and equity. It can go between 20 to 80% in cash equity, depending upon market valuation. In Jan 20, we were at 39% equity. With the benefit of hindsight, we should have been 20%, but fair enough, 39 was not bad. In March 20, we were at 75% equity. We should have been 80%, but fair enough, 75 is not bad. Today, we are at roughly 49% equity, and I'm sure today we would have bought something more. So, asset allocation can give you a discipline. It can't protect you from downside. There is no free lunch.
Indeed. I think Abhinav, there's a question. We can maybe take just one or two because we have 15 minutes left.
Yeah, we have Shobna with us. Hi, Shobna. Please ask your question. You might be on mute. Okay, so Neil, in the meantime, we can continue with the debate. And if any
Yeah,
listener have any question, you can send us the request and we'll add you to the group.
yeah. Folks, just one or two questions at max since we have about 14 minutes left. Nilesh, so just continuing along that, we have a feature where we ask uh, fund managers how they invest their own portfolios. And if I could just ask you the broad asset allocation question that, how much would you be in equity and how much in debt?
So, my portfolio right now is about 70% in equity and about 30% in real estate, debt, gold, and offshore assets.
Right. So you're, I mean, quite strongly affected by the market in terms of your portfolio. But of course, you would have a much higher risk appetite than the ordinary investor, just to make that clear.
So, my risk appetite is not higher. I'm not leveraged. I never leverage. But I'm a long term investor, and hence this 70/30 I can afford.
Yeah, fair enough.
And
Okay.
Nilesh, just one follow-up question. How much cash are you in right now?
So, I really don't have luxury of keeping cash. Whatever money comes goes by way of my SIP into NPS and mutual fund, and bearing those emergency money which my wife will require, I hardly have any cash balance.
Yeah, fair enough. Okay, I think we will not have any time for questions. I think it's time for closing comments. So, Nikhil, can we start? We began with you, so we'll take the first closing comment from you.
Yeah, sure. So just as a theme, Neil, I think there's a very interesting book called Donut Economics. It talks about uh, how we have been convinced to think that growth is good and how companies are made to believe that you have to constantly grow and that makes you a better company. Uh, I think ignoring the economics of it all, the world will have many other problems in the future that we might not have seen in our own past in the last 20 years or whatever. And we might arrive at this point where growth comes at a cost. And, countries which have done well, the developed Western countries, they've done that on the back of, a lot of carbon and a lot of extracting resource from the planet in a way. But for the emerging countries like India, I think when the future turns to a place where you have to kind of like justify the cost to the environment, we might somehow suddenly be stuck in this place where Western nations have taken advantage of that same resource, but it might become harder for us to do the same. So I personally feel companies which mitigate that over the next decade or two, it could be companies around better sources of storing energy. It could be better form of creating electricity, transmission. It could be a geoengineering company which uh, is able to manipulate temperature in a certain region. It could be something that, kind of like cleans up the water and makes a serious impact in pollution or reduces air pollution in Delhi, for example. I think that's a huge industry. We don't have any companies of scale which are operating around that in India, but that might become the theme of the next 2 decades, like maybe IT was the theme of the last 2 decades. And, personally, when I'm investing through my fund on the private side, I constantly look for companies like this. There again, the problem is that a lot of this innovation lies outside of India, but we have to figure out how to inculcate these companies in India and then really back them because that will probably be relevant in the decades to come.
Right. So essentially, innovators and innovators who tackle some of the big questions around climate that are confronting us.
Yeah, I think so.
Right. Shankar,
What's your question?
just your closing thoughts on how people can make money over the long term, given the state that we are in today.
Right. So first and foremost, one of the key things to remember is that we've had a pretty long, not India. India has been I still believe we are in a bear market and we have been so for the last, I don't know, 13 years. If you look at the compounded returns from January 2008 up until now, we are still barely, in the 8 or 9% kind of territory, which is nothing for a high interest rate economy like India. So if you only look at a recency bias driven mindset, the last 2 years have been good. But on a long term basis, Indian equities have delivered extremely disappointing returns. So to that extent, we are better off because things that do the best do the worst in a bear market. And the US has done the best over the last 11, 13, or 12 years, right from, let's say, 2010, 11 onwards, when the emerging markets went into a relative bear market and US went into a huge relative bull market. That cycle, I think, has run its course. And therefore, I think the US will hurt. US consumption is hurting. As I just mentioned, US tech companies, the big drivers of the US tech bull market, have probably hit a wall in terms of their growth options. So I think the US will hurt a lot more than the rest of the world, merely because it did the best. And remember, there's a lot of irresponsibility by central banks of the developed world. Not to say that our central banks in Asia have done much better, because even in India, our debt to GDP is now, I think, in the mid 90s now, which used to be in the mid 60s about 6 years back. So there has been profligacy for right or wrong reasons across the world. The West has taken it to a different level. I think all of that had to have a cost. It could not be cost free, that you could just, do all that you did without really at the core fixing the core economic problems that led to the 2008 crisis. So you just opened the spigots, you made an ordinary set of sprinters into Ben Johnsons by this permanent dose of steroids. But ultimately, they were Ben Johnsons. We are realizing that now. And we know how that story ended. We know this story is also going to end badly, at least for the developed countries. Therein lies opportunity for emerging markets. That's why I think on a relative basis, India is absolutely the best market that I can see. I think even China relatively will do well, because it has been a dog market over the last year or 2 years. If you look at Chinese internet stocks, Baba is up 25% in the last month's time. NetEase is up, JD is up. So a lot of Chinese companies have beaten the numbers estimates and have done actually very well. In the last 1.5 months of Carnage. So I think the needle is moving towards EMs away from the developed markets, and which should make domestic Indian investors who are limited in terms of their options to invest overseas very, very happy.
Indeed. Deepak?
Yeah, yeah. So I think quite interesting from a discussion angle. I think I would say India has a tremendous amount of inefficiencies, and therefore they're just bridging those inefficiencies, whether it is in the logistics areas, whether it is in whether it is in transportation, whether it is in communication. All of these inefficiencies will be broken down either through technology or through new companies or through existing companies expanding their offerings over the course of the next decade or so. This is where the massive opportunities lie, because I think this is where the biggest growth stories of the next decade will be formed. I think our country has largely been too focused on things like aluminium and steel and all of that stuff as players in indexes. I think it's the players that will break down inefficiencies that will survive. I don't know if a lot of them will, are even born today, but I do know that a lot of players are still playing. Example, in electric vehicles, it's not about being green, but it's actually about being substantially more efficient, running an engine which is feasible today, running off of a battery, providing greater horsepower, lower maintenance cost, and a much smoother ride. With no need for moving parts and all of that. This will change the world. It will change India as well. It will change India in probably different ways from the way it changed the world. The internet in on your handheld mobile changed India in a way that I think has never seen before, and a lot more things will come going forward. I believe here is the opportunity. The next few months may still be problematic for the markets, but I don't think you should let that blindside you into believing that India is a basket case, because I think everybody here on the panel also has said this and reiterated, there is a substantially good position India is in. And I'll add two things over here. The one, things that are bothering the world today are inflation, because they haven't seen it. We've seen a lot of it. We don't have a problem if the price of a dosa goes up from 25 rupees to 50 rupees in the course of 10 years. America has problems if the price of fuel goes up from $3 to $5 in the course of 20 years. So they haven't been used to inflation. We are perfectly used to it. We know where we are a little more capable of handling it. And two areas where inflation has affected the world today, or is affecting it, is food and fuel, both of which are relatively less in India. India's fuel inflation right now, on a year-on-year basis, is a lot lesser because the government has cut taxes and all of that stuff. But also, the food inflation is relatively lower compared to the rest of the world, because we make a lot of the food that we eat and we don't allow our food to be exported for the most part. So I believe we'll come out of this stronger, both because the crisis is going to hurt us a little bit less economically. Markets, of course, it'll hurt us more because, like Nikhil said, we're really small markets. We trade 48,000 crores a day today. And a day like today, we trade 48,000 crores. That's like one stock in the US for about 3 hours. Our whole market put together, intraday plus delivery stocks, traded just less than what one US stock would trade for 3 hours in a day. It's that small. So we will get affected from a market perspective. But I think economy wise, which is what matters in the probably the longer run, we should do really well in the next decade. So I think focus more on the next decade and, brace for impact in the next few months.
It's almost the reverse of COVID, right? Where we expected the economy to go down and the markets did well. It's almost like the reverse of that. Um,
Yeah.
Nilesh, last word to you.
Well, Neil, what happened with Indian cricket team is happening now with Indian economy. In the 50s, 60s, 70s, 80s, you could almost say that Indian cricket team was Shivaji Park Gymkhana cricket team. There were 5 or 6 players from Mumbai around him. The entire cricket used to evolve. And then there were many urban participants. That team occasionally used to win, most of the time used to draw, and couple of times also lose the match. Then democratization happened. People from semi-urban and rural India also started coming into play. Dhoni came from Ranchi. Someone, Kapil Dev, came from Chandigarh, though it can't be called a rural area. But this democratization changed the Indian cricket team. Now we go and win the test matches. Sometimes we draw and occasionally we lose. We have become number one test team on an almost consistent basis. The same thing is happening in Indian economy. Earlier, our growth was driven by large entrepreneurs, the house of Tatas, Birlas, Ambanis. Now there is availability of capital to deserving idea. I couldn't become businessman because my parents didn't have enough capital. My daughters don't need my capital because if they have idea, they'll go and raise it in the market. And this democratization or availability of capital will unleash the entrepreneurial spirit. Keep the faith on long-term India story. There's no free lunch in the market. So my recommendation, keep the faith, sip karo, mast raho.
Indeed. Well said. On that note, thank you very much. It was a very instructive discussion, and I hope that in these troubling times, you've got some more information and some more insights to guide you. Thank you, everyone.
Thank you, everyone.
Thank you.
Thank you, Neil. Thanks, everyone.
Thank you.